in the period 2000 until today, many people say, Rick, when's the gold price going to move? I say, well, I think in the year 2000. In 2000, the gold was $256 an ounce. Today it's 24 something. Gold price is up almost tenfold. It's increased at 8.4, 8.5% compounded for 20 years, 25 years, more than kept pace with inflation. So while the situation is hopeless from the point of view of society continuing as it is today, for you personally, for your listeners, the situation doesn't need to be as serious.
Gold prices have continued to break out, marking a fresh all-time high for the yellow metal. It's been a brisk move over the past 3 weeks from when gold was previously testing a key spot of support while threatening a deeper breakdown. Since then, however, bulls have come back very quickly. The second quarter was marked by range-bound price action and mean reversion, but there was a large pull from major psychological levels. Based on his analysis, Rick Rule notes that the price of gold has nearly increased tenfold since 2000, emphasizing its role in personal financial resilience. He emphasizes that during economic crises like the 1970s, devaluing the dollar significantly eroded its purchasing power. However, those who held gold or silver experienced increased purchasing power, illustrating precious metals' effectiveness as a hedge against inflation. Throughout history, periods of high inflation have coincided with rising gold prices. For example, during the 1970s, the United States experienced rampant inflation due to oil price shocks, which led to a significant increase in gold prices. Investors flocked to gold to protect their assets from eroding inflationary pressures. In the interview, Rick mentions a J.P. Morgan Chase study showing precious metals and related investments comprise only 0.5% of total U.S. savings and investments. He notes the potential for significant growth if this trend reverts, predicting increased interest in precious metals. During recent months, positive changes were observed in the gold market due to increased investment demand. Moreover, global gold reserves increased by 17.5 tons, which is an estimated value of $1.4 billion. This growth indicates investors' renewed interest in gold as a reliable asset in conditions of economic uncertainty. Regarding gold specifically, Rick explains that since 2000, its price has risen almost tenfold, outpacing inflation significantly with an annual compounded growth rate of around 8.4 to 8.5%. Despite societal challenges, he suggests that individuals can protect themselves financially by considering alternative investments like gold. Now, we present the clips of Rick Rule's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
When Social Security was enacted, it provided poverty-level existence for people beginning at age 65. And the average life expectancy of an American male at that point in time was 66 years. Now it's 84 years. So likely we will end up having to means test Social Security, which is to say to upper income taxpayers like myself, yes, you put in way more than you're going to get. Too bad, so sad, that's what's going to happen. We could change the vesting years from what has now fallen to 62 back up to some number like 80 over time. Ugly, ugly, ugly political circumstance, but not dealing with it implies no facility with arithmetic, no facility with facts. I bring all this up in the consequence of a gold and silver discussion, because when you look at the way that we as a society deal with this, rather than attacking the problem, what we do is we devalue the benefit. If you look at the last time we faced this circumstance, that was in the decade of the 1970s. And we faced the circumstance, or rather the solution to the problem that we faced, was debasing the purchasing power of the dollar by 80%. Robert Friedland says it's not serious if during the decade of the 1970s you personally were a gold holder or a silver holder. your purchasing power went up, not down. Similarly, in the period 2000 until today, many people say, Rick, when's the gold price going to move? I say, I think in the year 2000. In 2000, the gold was $256 an ounce. Today it's 24 something. Gold price is up almost tenfold. It's increased at 8.4, 8.5% compounded 25 years, more than kept pace with inflation. So while the situation is hopeless from the point of view of society continuing as it is today, for you personally, for your listeners, the situation doesn't need to be as serious. JP Morgan Chase published a study suggesting that the market share of precious metals and precious metals related investments comprises about 0.5% of total savings and investment assets in the United States, which is to say it's as irrelevant as a pimple on an elephant's behind. JP Morgan Chase also pointed out the statistics suggest that the 4-decade mean market share of precious metals and precious metals related investments is 2%. So if we merely have reversion to mean, demand for the stuff grows fourfold. That's what I think is going to happen. I'm not one of those who suggests that the U.S. dollar is going to go the way of the dodo. I'm not one who suggests that gold will eclipse U.S. Treasury securities as savings instruments. I just think they'll lose less badly, precisely because the market share, even the mine share of gold, relative to other investments is infinitesimal. Now, of course, I came of age as an investor in the decade of the 70s, and gold was everywhere in the investor mindset. It is estimated, although no statistics exist, it is estimated by JP Morgan Chase that the market share of precious metals and precious metals related investments in the United States in 1980, 1981 crested at 6 or 7% compared to 0.5% today. So as I say, if your friend, your professional investor or your active investor was to consider reversion to mean as an investment characteristic, he might tend to look more favorably at gold.
According to Rick Rule, despite a nominal yield of 4.3% on the 10-year Treasury, after subtracting what he believes to be a more realistic inflation rate of 2.6%, investors were gaining a real yield of over 1%. However, he expressed skepticism about the accuracy of the CPI, citing personal experiences where he believes his purchasing power is declining more significantly than the CPI suggests. According to MarketWatch, the government reported that the U.S. Consumer Price Index unexpectedly fell by 0.1% in June, marking the first decline since May 2020. This disinflation trend has increased the likelihood of Federal Reserve rate cuts, with interest rate futures prices now reflecting an 85% chance of a rate cut in September. As a result, the dollar has weakened, and Treasury yields have declined, making gold more attractive to those seeking conservative assets. Considering his analysis, Rick suggested that this long-term trend of declining interest rates may have shifted around 2001 and 2002, leading to a renewed interest in commodities like gold as investors seek alternatives in a potentially re-emerging era of negative real interest rates. Let's get back to the interview.
I think you have to look beyond the Fed funds rate to the real rate of deterioration and real interest rates. If you looked at the 10-year Treasury rate, which I think is probably more important than the Fed funds rate, and you juxtapose that with the CPI stated rate of inflation, you would say that the real rate of return on a U.S. 10-year Treasury was 4.3 minus 2.6, which is to say that you were getting real yields in excess of 1%. I don't believe that the CPI accurately states the rate of inflation. If you define inflation as the deterioration in the purchasing power of real wages and real savings. When I look at the basket of goods and services that I consume, I believe that my purchasing power is deteriorating by about 7.5%. If you believe that to be the case, then the negative interest rate that you're suffering is closer to 3%. I think the juxtaposition of the CPI and my average is fairly easy to do. They hedonistically adjust the CPI, which is to say that they tell me what my computer is worth, irrespective of what I paid for it. And they don't include when it's inconvenient, food or fuel, which is difficult for me because I like to eat. But my greatest criticism is that it doesn't include tax. Now, not defining tax as a good or a service is certainly something I understand, but it makes it difficult to use it to quantify my cost of living. So I would suggest that what you saw in the period of the 70s was a period of increasing nominal interest rates, and until the end of the decade of the 70s, a period of decreasing real interest rates. The nominal interest rate, as expressed by the U.S. 10-year Treasury, would have been a 7 or an 8 or finally a 15, but the rate of inflation was consistently between 12 and 15%, which is to say the real interest rates were negative. After the Volcker-Reagan experiments, largely successful in my view, in the early part of the decade of the 1980s, we experienced a 40-year benign period with declining real and nominal interest rates, with the hegemony of the US dollar, which allowed us to export our political idiocy and our inflation to other people. A wonderful set of circumstances. My belief is that that trend line was probably broken 2000, 2001, 2002, and we're back into a period of negative real, if not nominal, interest rates, and hence the interest in gold.
Looking ahead, demand for gold has solid support from central banks. Central banks in emerging markets tend to intervene in currency markets when their currency appreciates against the US dollar, UBS said. Will this increasing interest in precious metals persist, or are there other emerging investments that could rival its appeal?